Today I illustrate how implementing a logical and sensible stop loss into a trading strategy can significantly improve the quality of the equity curve. Stay tuned. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. As a trader, you'll benefit from cost-effective market access via multiple trading platforms and APIs. These enable trading and investing in any US stock, over 60 of the most liquid futures contracts, FX and CFDs. You can even diversify your portfolio by buying and selling other traders' strategies as investable assets themselves. So, if all of that sounds interesting, learn more by clicking on the link top right now or find further links in the description right below. Now back to today's tutorial. Stop losses are essential in trading to reduce the risk from open positions. In this series, I've been working step by step as part of an academic exercise to implement an Ichimoku strategy, and in this episode, I show how adding a stop loss into the strategy helps to reduce drawdowns on the equity curve and smooth out growth, leading to a fairly dramatic improvement. Let's take a look. This is the next episode in the Spotlight on Indicators series, where I'll be looking at a number of different technical indicators and putting those to the test as I build and backtest simple strategies using them. You can get access to all of the episodes of the series from a link in the video description. Specifically, in our Ichimoku strategy that we're looking at, these were the results as we left them last time. Do bear in mind that at the moment we're just using minimum lots, and so the absolute profit values here are very small, but we should see those increase significantly as we switch over to a risk-based position sizing model in the next episode. So the equity curve that we see here is based on a simple crossover of the Tenkan-Sen and Kijun-Sen lines of the Ichimoku indicator, and I've just used the default parameters there, so this has not included any type of optimization of the Ichimoku indicator. I've also applied a noise filter, which in this case was the Kaufman efficiency ratio, and that's to reduce the number of whipsaws when the price action of an asset is exhibiting particularly noisy behavior. And then the third factor that has led to this is that we are just trading the JPY Forex pairs here. When I performed analysis in the previous episode, it was just as I'd expected right at the beginning of this series, and because Ichimoku is predominantly traded in the Asian session and specifically in the Japanese markets, these JPY pairs do appear to work much better than many of the other currency pairs. There were some other non-JPY currency pairs that also performed well, but these results do not include those. I feel I need to do some further research with other Ichimoku strategies to see if they also perform well, and if so, then they could be included. But for now, because I don't want to overfit, I'm just sticking to those JPY pairs. Now, just to put some quantifiable metric behind this, one of my preferred metrics is what's called the compound annual growth rate over the average drawdown. And I've produced videos on this in the past, so you can look those up if you want more details. But this at the moment is coming out with a value of 0.456. Now, this isn't really a metric that's well suited to a fixed position size. However, as I said, we'll be switching over to a risk-based position size model in the next episode, so these figures will become much more relevant. So this is the first video that's going to look at the implementation of a stop loss. So let me just talk through with you the rationale behind where I'll be setting the stop loss, and this is very simple. It simply looks for the crossover that we've already implemented into the strategy, and then if this is a bullish crossover, meaning that the Tenkan-Sen line has crossed over and above the Kijun-Sen line, then the stop loss is simply set at the bottom of the Kumo here. Now, the reason that I've done that is because this gives the price a chance to get support from the Kumo. So if price goes against the position initially, it has a good chance of getting that support from the Ichimoku cloud before hopefully going on to become a profitable position. Now, as I've said before, I'm just implementing a very basic, simple strategy here. So I'm not going to do anything specific with the stop loss. I'm not going to trail that behind price. I'm not going to adjust it in any way. I'm simply using it to limit losses on the particular position, and it will stay at this level for the duration of the entire trade. Many of you, I'm sure, might want to experiment with different types of stop losses, trailing stop losses, and so on, in order to improve the results that I achieve as part of this academic exercise. And we have another example of that right here, where we get another bullish crossover, and so in this case the stop loss will be set at the bottom of the Kumo at this point in time. So let's now take a look at the code that I've used to implement the level of the stop loss. The first thing to bring to your attention are these three lines here. And these rely on what can best be described as a helper class called CI Ichimoku, which is provided by MetaQuotes themselves. And the intention of this is to make the use of indicators, and in this case Ichimoku specifically, easier to program into expert advisors. And with Ichimoku being a particularly complex indicator, this is, in my view, a much better way of programmatically implementing Ichimoku than simply using the standard indicator handles. Now, I'm not going to go into any more detail around this in this session, but in about 4 episodes' time, I'm going to dedicate an episode specifically to using this class, so that anyone that does want to do this and wants to implement using this helper class, it should provide you with all of the information you need to do that. But for now, all we need to know is that we're using that class in order to get 2 values. We're getting the value of the Senku span A and the Senku span B. And we're getting those for the current bar at this moment, which I just simply store in this variable here. So coming back to the price chart here, the Senku span A line is the green line here that you see at the top of the cloud, and the Senku span B line is the red line that you see here at the bottom. So if this was the current bar in the price action here, it would be giving us this value and the value here, which of course is what we need to be able to set our stop loss. So with those values, if the logic above has determined that we have a potential long trade, then we take the 2 values, the Senku span A and Senku span B, and we use this function here called mathmin, which is another standard function provided by MetaQuotes, to give us the smallest of those values. And so what that means, if we have a long trade, we're going to set it at the bottom of the cloud, whereas if we have a short trade, then we're going to use mathmax, which gives us the larger of these 2 values, i.e. it will be the top of the cloud. Now there are just 2 more lines I've added here, and these are just to make sure that the price is on the correct side of the stop loss. And we won't allow the trade if that's not the case. So in the case of a bullish crossover, which of course would result in a long trade, we're performing a check here to make sure that the price is above the minimum value of the 2 Senku span lines. So in other words, the price is above the bottom of the cloud. And this check just ensures that the stop loss that we set below will always be on the right side of price. If it isn't, then we simply say that the trade will not be allowed. Now, in the case of a bearish crossover, which of course would result in a short trade, here we're making sure that the close price is less than the maximum value of these 2, or in other words, that the price is below the top of the cloud. If it is, then we set the signal status to short. If it isn't, we will not allow that trade to execute. So it's just a little bit of logic to make sure that we don't get any invalid stop errors issued by the terminal. So let's now run that in the strategy tester, and we'll come back to that in a moment once it's complete. Okay, so that has now completed, and straight away we can see that this is a more consistent growth in the equity curve than we saw previously. So the stop loss does appear at first sight to improve the quality of the strategy. But what we really want to do is see that alongside this previous baseline. So the orange line here represents the results that we've just achieved. And by studying this, we can see that the drawdowns have been reduced significantly. So you can see here, for example, there's a really big drawdown on the green baseline, another really big drawdown here. But with the stop loss implemented, those drawdowns are significantly smaller. But overall, the growth is very similar, it's just slightly better. And overall, where the green baseline here makes large profits at the beginning, it then goes fairly flat and then makes a profit at the end. The new orange line with the stop loss implemented is a much more consistent growth. And just to look at that in a quantifiable way, the compound annual growth rate over average drawdown here is 1.3, so significantly better than the previous. So in the next episode, I'll continue with something that's related to the stop loss, and that's using that worst case stop loss now to standardize trade risk. And so I'll be implementing a new position sizing model based on achieving the same risk for each trade. And it's this step here that will see the absolute value of the profits increase considerably. And then in the episode that follows, I'll continue with the implementation of the rules of the Ichimoku strategy and introduce a trend filter into it. That's it for this episode. If you're not already, please do subscribe to the channel and make sure you also click on the notification bell, and this will mean that you get notified when new episodes from Darwinex are released. Now, until next time, trade safe.